What's up guys, Ben here and welcome to Motivation to Invest. We live in crazy times. The economy is still struggling, yet the stock market is at all-time highs. Now this may seem like a challenge for investors, but the real challenge is what's going on inside our minds. So in this video, I'm going to reveal my top 6 deadly investor sins, which I bet many of you guys are doing. Trust me guys, you'll find this video fascinating, and I believe you'll spot a few of these sins which you do regularly. I know I did. So if you're ready to find out these 6 deadly psychological sins and how you can prevent them and become a better investor, then let's get ready and dive in. Right guys, so here we are, we're inside the presentation. 6 sins of investor psychology. It's not enough to know what you do, but you also must do what you know. And that means it's very easy to have the knowledge of what you're supposed to do when you're investing, but taking action during crazy times can be emotionally difficult. So kicking things off at sin number 6 is confirmation bias. Now I see this one so much. So confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior beliefs or values. So what does this mean? Well, basically this means that say you've invested into a stock, let's say it's Tesla, and you love Tesla and you're a big Tesla bull, then you only read articles from other Tesla bulls and other people who are bullish on Tesla, let's say Ark Invest. Now, there's nothing wrong with taking in that information, but rationally, it's good to actually seek out people who are opposing your views and get their opinion. So in investing, this can represent itself as the endowment effect. So investors place greater value on something they already own. So if you own a stock, you tend to justify why you own it. Oh no, that's a great company because of this, this, and this. Whereas you don't question as much the negatives of the company. So the solution is to ask better questions and actively seek qualified people who disagree with you. Now this is quite difficult for many because people have an ego. So if you think something is right and you think something is great and you think this stock is great, it's very difficult to listen to somebody who thinks the complete opposite. But believe me, the world's largest hedge fund manager, Ray Dalio, does this all the time. And I read that in his book, The Principles. And as Ray Dalio says, all opinions aren't created equal. You look for experience, you look for track record, you look for education of the person you're listening to. Let's say Warren Buffett's opinion versus a builder. Now, I'm not saying one is smarter than the other, they're just smart in their own disciplines. For investing in stocks, I'd speak to Warren Buffett because he has a massive track record of being successful. He runs Berkshire Hathaway and he's been investing his entire life. However, with the builder, I'm not saying his opinion is invalid, but I prefer to ask him more about building. Let's say I'm doing a wall or I'm doing a kitchen or I'm doing some sort of refurbishment on a house, then I'm more likely to speak to the builder, even if I have Warren Buffett sitting right there. Know who you're getting these opinions from. But the key is to triangulate multiple opinions and then make your decision. And as Ray Dalio says, you don't know what you don't know, which is so true. So what about my opinion? I'm not saying I'm this genius of investing and you should always listen to every word I say, but let me just give you some of my information and background so that can help you guys make a more informative decision. So firstly, I have a first-class electrical and electronic engineering degree. If that's important to some people, I have a diploma in business and finance from college. I've read over 200 books on business and finance. I have a 6-figure investment portfolio. So I'm not one of these YouTubers. I've seen quite a few these days. They have like $2,000-$3,000 invested and they're telling other people how to invest. And personally, there's nothing wrong with having $2,000-$3,000 portfolio. Everybody's got to start somewhere. But I think to be giving information out to people and telling people how to invest is quite irresponsible. Me personally, I have a 6-figure portfolio now, so every decision I make, especially if I'm putting a lot into one stock, I tend to calculate it quite well and I put a lot of energy into it. Whereas if I'm investing, say, £10 into one stock, which some people are doing, and then I'm telling people, yeah, this stock's great because of this, this, and this, then they might be thinking completely different numbers. They might be saying, okay, I'll put 20,000 or 50,000 into that stock. And then if they lose that 50,000, they're going to be really annoyed. So it's a completely different ballgame. The bigger the numbers get, the more you need to be switched on. Believe me, when those numbers start getting bigger, you'll learn the facts because you've got to. And that's why on this channel, I always offer full disclosure. I tell people when I'm investing into stocks, what I'm investing into, and I also say if it's a small position. Because yes, I have a 6-figure portfolio, but not every stock is a massive position. To be honest, most of my portfolio are small positions. So what else? Well, I'm also invested into multiple small businesses and properties, or real estate as you call it in the US. I have a track record of successful investments, and I've made over 200 YouTube videos on investing. The research that goes into all these videos actually does improve my investing knowledge and my investing skills. Because to explain something to somebody else, you have to know it yourself crystal clear. Feel free to subscribe if you guys haven't already and you think you get some value from these videos. But having said all that about my credentials, I do state that I'm not a financial advisor, and you should triangulate my opinion with other opinions and, most importantly, your own. Because at the end of the day, it's your money on the line and you're investing into these stocks. So you have to look at your own personal financial position. Do I need this money in the next 1 year? Do I need it in the next 2 years? Would I be devastated if I lost this money within 6 months or it decreased by 40%? Check out my previous video on stock market patterns and core 4 investing principles if you want more on that. Onto my psychological sin number 5, and that is recency bias. So recent experiences carry more weight in our minds when evaluating the odds of something happening. Just after 9/11, you may be thinking, oh my God, another terrorist attack is going to happen. But in fact, that was probably actually one of the safest times to fly because people are actually more vigilant, security is at an all-time high, so it's arguably, that's one of the safest times to fly. One of the most dangerous times is when nobody is talking about terrorism and nobody is talking about security issues on airplanes. So probably the most dangerous time was just before 9/11. Warren Buffett has a quote on this: investors project out into the future what they have most recently been seeing. This is why investors usually buy the wrong thing at the wrong moment. Basically, a lot of investors arrive late to the party and buy at the top of a bubble. Now, this has happened with the Bitcoin bubble, and it also happened in the dot-com crash. Everybody's sitting there, they've seen everybody else making lots of money, and then they say, no, I'm finally going to make the plunge. They jump in and boom, the bubble pops. This is because of recency bias. The biggest mistake a small investor can make is buying when the market is going up, thinking it will continue going up, and sell when the market is going down. That was by Harry Markowitz. He's a Nobel Prize winner who invented modern day portfolio theory. Ask yourself, when have you in the past had recency bias and used this when investing? Now, you've got to be completely blunt and honest with yourself. I know I have. I've sat there thinking of certain stocks. Ooh, am I going to miss out on that one? Should I invest a little bit now? But it's best to just weigh it up yourself. There is a simple solution, and all these big investment firms do it. Don't sell, rebalance. This forces you to sell high and buy low. I know you may be in love with a certain stock, but when you rebalance your portfolio, it actually puts you in a much better position. So what is portfolio rebalancing? Well, basically, portfolio rebalancing is when you have a position in your portfolio and it starts to increase massively in value. Let's say it gets too large. So you want to keep it at, say, 20% here. You sell off the portion of the stock until it reaches that 20% mark. And when it goes over, you trim your position. Now, all big investment firms do this. And I even did some previous videos. I did one about Cathie Wood when she was trimming her position on Tesla because Ark Invest can only have 10% of Tesla in their portfolio. These investment firms do it, and they're not idiots. This is the smart money. So follow the smart money and do what the smart people do. Psychological sin number 4, and that is overconfidence. So we overestimate our own abilities and knowledge. Study: 93% of student drivers stated they were above average at driving. Now, statistically, that's impossible. And even ask yourself, are you an above average driver? And I just comment below, guys, because I'd love to know this. I bet 93% of you will say, yeah, I'm above average. Very few of you will say, actually, I'm really bad at driving. On to deadly sin number 3, and that is having a home bias. So many investors only invest in the stocks of their country. Morningstar study: average American investor has 73% invested into US stocks. However, the US economy only accounts for half of the global equity market. Now, I understand a lot of you guys will say, yeah, but many of these are international companies, and I do agree in that sense. However, even Swedish investors, they have 48% of their money in Swedish stocks. This only accounts for 1% of the global economy. So that is completely bonkers. My advice: diversify internationally. I've actually got a lot of videos on China.
China.
The second largest economy in the entire world, and it's actually fast becoming the first. So check out my videos below, or search using the search box on my channel, search China, and there's plenty of Chinese stocks on there. Deadly psychological sin number 2, and that is survivorship bias. Now, this one is so common. So survivorship bias is a common logical error that distorts our understanding of the world. It happens when we assume that success tells the whole story and when we don't adequately consider past failures. Just because you win doesn't mean your strategy is correct. Let's say you had a dartboard and you were picking stocks by just throwing darts blindly at a dartboard. And let's say for some reason you hit the stock Tesla and you said, okay, I'm going to put in £100,000 or $100,000 into that stock, let's say last year, because you blindly got it with the darts. You will be up now by around 600%, so well done. Congratulations. Take advantage of that win. However, be self-aware enough to know that the reason you got there was actually a bad strategy, and it's not, I wouldn't recommend throwing darts at a dartboard blindly. Another analogy for this is, let's say you're playing Russian roulette with the Russian mafia. And you know Russian roulette, you have the revolver and you have one bullet in and you've got a click. They say, okay, if you don't die out of 3 shots, you'll win $1 million or £1 million. And you play the game, you win, and you win £1 million. And yeah, you got extremely lucky. But then if you go around to, say, schools and people and telling them, Ash, this is so easy. It was 10 minutes and I won $1 million. You can do it. It's so easy. Look, I did it. Now, if you're deluded and you think that that's a good strategy, that's actually going to be negatively affecting other people and even yourself, because you'll blindly think it's a great strategy and you'll probably go and do it again. Why would I go and invest or do anything else? I could just go play Russian roulette again and then die. And there's actually a guy who this lad here, who actually played Russian roulette and shot himself. So people do play this game. Complete madness. But just be aware of how luck plays a part in all your wins and losses. And finally, number 1 on my list, the last psychological sin, and that's greed, fear, and loss aversion. So be self-aware of your emotional state when investing. Financial losses cause people twice as much pain as the pleasure they receive from financial gain. And that's from Daniel Kahneman, a psychologist. He also wrote the book Emotional Intelligence, which I read recently. So just be self-aware. Say, okay, am I feeling greedy? Am I getting FOMO? Am I being fearful if this market is crashing? Am I scared? Am I unhappy to see my stocks being lost? And just be aware of that. Listen to the thoughts, listen to the feelings, and then make a rational decision. True wealth is emotional, psychological, and spiritual. Financial wealth is just a great tool to help you live a great life. That's why on this channel, I help people to become financially free by providing insight into my investing tips and my investing strategies. So if you've found some value in this video, then feel free to give it a big thumbs up. That really helps out with the YouTube algorithm. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I will see you guys in the next video. Invest safe.